Hello, and thank you for joining us at XM.com. You're watching today's Daily Market Comment by Mario Sajikiriakos. I'm Cristina Marujos. The latest U.S. employment report will be in the limelight today as nervous market participants search for anything that might convince the Fed to shift into lower gear later this year. There have been several signs that the U.S. labor market is losing momentum, and corporations are desperately trying to protect their profit margins from raging inflation, and slashing labor costs is an easy way to do so. The good news is that this trend has just started, so it's probably too early for any real weakness to show up in today's jobs report. This is most likely a story for the summer or beyond. Instead, a solid report is expected overall. In the markets, the playbook is that the dollar tends to spike higher or lower depending on whether the jobs numbers are stronger or weaker than expected, and then retraces the initial move in the following minutes or hours. This has been a consistent pattern since the pandemic hit. Nonfarm payrolls have essentially turned into an intraday volatility event, not a trendsetter like in the past. The OPEC Plus alliance announced it will dial up production to ease the shortage in oil markets. Output will be boosted by 650,000 barrels per day in July and August. However, oil prices rose on the news, which suggests traders don't think this will be enough to move the needle. It was seen mostly as a symbolic gesture rather than a sea of change for thirsty energy markets, since most OPEC members are already producing below their quotas and spare capacity is dwindling. Crossing into equity markets, the mood improved yesterday. The S&P 500 rose by 1.8% despite Microsoft lowering its earnings guidance for the current quarter, blaming unfavorable FX moves. With the Fed expected to keep hammering away with rate increases until inflation is under control, any bad news around the economy might even be viewed as positive for equity markets by lessening the need for rates to enter restrictive territory. Indeed, it is quite common for the dollar and U.S. equities to move in opposite directions after jobs numbers. Meanwhile, euro-dollar staged a meaningful rebound yesterday, recovering all its losses for the week despite some signals from the Fed's second-in-command that it's too early to be thinking about a pause in rate increases. Volatility is likely to remain elevated in the world's most traded currency pair, with next week's highly anticipated European Central Bank meeting coming hot on the heels of today's U.S. jobs data. Thank you for watching today's Daily Market Comment here at XM.com. Have a great weekend.